Fear of missing out events, FOMO, how narratives manufacture market stampedes. Flint West reporting. Let me tell you what a fear of missing out event really is. It's not stupidity, it's not greed, and it's definitely not random. A fear of missing out event occurs when a narrative-driven mechanism attracts capital faster than truth can be evaluated, allowing early movers to exit while latecomers mistake visibility for value. That's the sentence. Everything else is just the anatomy. Because markets today don't just price assets, they price stories. And more dangerously, they price wrappers. Here's how it works. A small group, usually sophisticated, sometimes cynical, always early, identifies a mechanism, not a business, not a product, a mechanism, a wrapper, a shortcut, a structure. SPACs, NFTs, privacy coins, AI infrastructure. Pick your decade. The mechanism doesn't have to be fake. In fact, it works better if it's real. SPACs really do streamline IPOs. NFTs really do solve non-fungibility. AI really is transformative. But here's the trick. The wrapper becomes the trade, not what's inside it. And once that happens, fundamentals stop mattering, not because they're irrelevant, but because they're slow. Truth takes time. Narratives travel at the speed of dopamine. So the narrative gets seeded. This is inevitable. This is next. This is where the smart money is going. If you don't get in now, you'll never get another chance. Early movers take positions quietly. Then they talk, then they repeat, then the chart starts moving. And once price moves, it stops being information and starts being persuasion. Because humans don't see truth in absolutes. We see it relatively. We don't ask, is this valuable? We ask, is this going up? We are hardwired to overrate appearances and underrate substance, to follow signals instead of interrogating sources, to assume that momentum implies correctness. That's not a moral failure. That's biology. Dopamine clouds judgment. Social proof substitutes for analysis. And independent evaluation is a muscle most people were never encouraged to build. Why would they be? The line of least resistance is following. It's easier, it's safer, and when it works, briefly, it feels genius. So the crowd forms. Media picks it up, experts explain it after the fact. Retail arrives right on time, which is to say, too late. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. And this is where the asymmetry reveals itself. Early entrants aren't confused. They're exiting. Liquidity has arrived. Attention has peaked. The story has done its job. What's left behind isn't belief, it's exposure. We saw it with SPACs, where the structure went public before the businesses deserved to. We saw it with NFTs, where the wrapper outpaced the worth of the art. We saw it with crypto narrative rotations, privacy coins, layers, themes. Always after insiders had already positioned. And we're watching it now in AI, where capital expenditure is racing ahead of proven returns because inevitability feels safer than skepticism. Same movie, different costumes. And here's the uncomfortable truth. These aren't bubbles caused by ignorance. They are stampedes caused by incentives. Narratives are cheap to produce. Truth is expensive to verify. And in a zero-rate, post-discipline world, speed beats accuracy every time. So fear of missing out events will keep happening. Not because people don't learn, but because the system rewards those who move first and punishes those who wait to be sure. Until participants learn to separate mechanism from substance, until they stop mistaking attention for validation, until truth is allowed to move as fast as hype, visibility will continue to masquerade as value, and stampedes won't be an accident of markets. They'll be the business model. Flint West, signing off.